Hey y'all, this is Colin Nathan Aline, the real estate boy. So I'm hoping you guys are able to hear me and got this mic set up here. Usually I have a microphone, but it seemed that kept messing up. But today we're going to be talking about the rising interest rates and what they mean to construction in Philadelphia. Now this is an opinion piece, so I'm going to be taking this from the Philadelphia Inquirer. All right, so we'll be talking about this article that they have, and I'll be giving you my opinion. This article just hit the press about an hour ago. Okay, and this article was from Jake Bloomgard. All right, so the article says, well, the article is talking about construction in Philadelphia. So what does these rising interest rates mean? Now, I live in University City, and City, in University City, you can see all type of construction going on. You can, I mean, there's about four or five projects, big, mid to high level um, apartment buildings that are going out. So these are things that I can see myself. But there's a lot of construction going on. So let's see what this article says. All right. So the article says that the development industry in Philadelphia region has seen a busy few years. The fate of new office and retail construction is still to be determined. But after the initial shock of COVID-19 pandemic, the housing and industrial markets are booming. So we're talking about in the Philadelphia region how the markets are booming as far as construction goes. Okay, it says many neighborhoods have seen a degree of developer attention unparalleled in recent history, from Germantown and the western edge of University City to Kensington and the neighborhoods north of Brewery Town. The remote work trend also fueled an aggressive expansion of warehouse infrastructure throughout the region, and that was led by Amazon. So, like I just said, we've just been seeing an unparalleled level of expansion of construction in Germantown, like it mentioned, University City, Kensington, Brewery Town. I mean, it's not like Nashville or some parts of California where you see a bunch of cranes. But if you come to University City, you will see a bunch of cranes. Okay, Germantown has a lot of construction going on there. Just in the city in general, there's a bunch of construction going on. And what they're saying is that it was fueled. One of the things that fueled it was the remote home trend. So people working from home definitely fueled um, the aggressive expansion of warehouses. Why? Because people are buying stuff from home. I do that. All right. I do that a lot, buying stuff from Amazon. So since Amazon has been booming because people are staying home, so they're on the computer more. Since that's booming, then what's happening is that there's more warehouses that need to store these things. Okay. So let's continue with the article. It says all this activity has been juiced by the extremely cheap cost of borrowing, as interest rates remained at historical lows during the rebound from the pandemic generated crash. All right. So we had a pandemic. Everybody was all kind of cooped up. And then when they let us go, it was a go. And people just started spending money. Let's see, my man Luis, do you think the remote trend had a positive or negative impact on the buyer's market? The remote trend, okay, let's look at what the remote trend did. What the remote trend did is it kept people home. People were used to going into their work environment, their work office, but now people are home. Now people are home. One thing that it did do for the buyer's market is it took a lot of homes off the market. Okay, it took a lot of homes off the market. Why? Because people were at home more, number one, and then number two, during the pandemic, people didn't want other people through their house because they were scared of the pandemic. So they were scared of the pandemic. So that took a lot of homes off the market, and that's one reason a lot of people don't talk about is why there was a shortage of homes. There was a shortage of homes because Normally, a lot of people, what they'll do is they'll sell their home while they're still in it. Well, mostly all those people took their homes off the market, and they took their homes off the market because they didn't want people coming through their house with COVID. All right. So I hope that answered your question, Lewis. All right. So let's keep on going with this article. The article says, but as inflation soared over the past year, the Federal Reserve has began pumping the brakes on the economy, rising interest rates and making borrowing more expensive. These changes had an oversized impact on real estate deals, which unfold over years and are dependent on large inflows of investment capital. All right. So it says that inflation has been building for the past couple of years, and the Fed, they're really looking to attack the interest rate. Meaning what? That they don't really care about. I'm gonna say it like this: they don't care about the housing market. They care about the economy. And if the economy is still soaring, they're trying to pump the brakes on it. They don't care that the interest rate is making this more expensive for people to borrow. So what they're saying here is that um, these changes are having an impact on real estate deals because real estate deals usually fold. These construction deals, they usually unfold over years. Okay, so it's almost like a big ship. Okay, if you have a little ship, it's easy to turn. Okay, you're going left, you need to go right, you can turn. But if you have a big ship, meaning a huge ship, then you can't turn. Okay? That huge ship is turning like this. So somebody gets involved in a real estate deal, and then now they need to pull out because because of the rising interest rates, it makes the monies more expensive. Okay? If it makes the money more expensive, then if it makes the money more expensive, then maybe the deal isn't so good. Okay. So that's one thing about these real estate deals is that it's not overnight. But that's just one of the risks that you kind of deal with when you're uh, investing in real estate. Okay. If it was a guarantee, then the returns would be a lot worse. So this article says that the borrowing environment is expected to only get tighter. A strong anticipated July jobs report led many Fed watchers to predict that a substantial further rate hike will come in September and that the additional increases may not occur later this year. Excuse me, let me go back. It says the additional increases may now occur later this year instead of 2023. And what they're saying here is that originally people knew that the Fed was going to raise rates, but they thought it would kind of be like even handed, okay? Meaning that they wouldn't go hard so quickly. But that's not the situation. The situation is that the Fed, they're pumping on the brakes and it's not stopping the inflation. People are still buying like crazy. So what's going to happen is next time they're going to punch a little harder. And then next time they're going to punch a little harder. So people thought, okay, well, they'll give it a little bit of interest rate hike this year. And then next year, it'd be a small interest rate hike also. No, the Fed is going hard right now. And what that's doing is when you have a construction project, you have numbers that you're looking at and that you're forecasting. So when those things don't happen, they can make your numbers look bad. Okay, but again, it's a risk that you take on. So the article continues to say, future projects could be compromised. Okay, it says climbing interest rates are already having an effect on home buyers, some of whom are finding themselves priced out of the market. But what will the effect? What will the effect on the larger development market in the Philadelphia region be? And he's correct. These interest rates they have cooled down the buying a little bit, but people are still looking to buy homes. So yes, it has cooled it down a little, But buying a home is situational. Okay, what does that mean? That means that people need to buy a home because maybe their family is now big, is bigger than what it was. So they got a one bedroom because they didn't have any kids. Now they got two or three kids. They got to get out that one bedroom. So yeah, the interest rates going up is going to affect them, but they really have to move. So if they can afford it, then they'll move. But there's some people who just wanted to buy, but now the interest rates have gone up. So now it's priced them out, meaning that now they can't afford to buy the home they wanted to buy. So now what they have to do is they got to go back to the drawing board. So the larger development market in Philadelphia has this rising interest rate market affected them. All right. It says projects, let me move this up a little bit. It says projects are at um, projects that are pretty far along in the development process probably won't be impacted, but it affects the pipeline. And this was said by the former president of Liberty Property Trust. Okay, bill. It also says that developers face more dramatic cost hurdles now that the Federal Reserve is tightening. 2 years of the pandemic, supply chains remained snailed, and construction material cost 19% more than it did a year ago. And that's according to the National Association of Home Builders. All right. In combination with rising rates, that means the cost to build is higher than anticipated. The cost to finance debt is higher, and what a tenant or buyer will pay is lower. So it's almost like a trifecta. All right. So what's happening in this rising interest rates? That means that the cost of building is higher. The materials are higher. The cost of financing is higher. Meaning what? The monies that you borrow, it costs more, and the tenant or the buyer, they're paying less. So this is all kind of a shock system when it comes to the developers. Okay. So it says the changing equation of development means that some projects won't happen, especially if they are in the early stages. So there is a lifeline or process, okay, that goes with development. All right. So you have your beginning, you have your middle, and you have your end. So what this is saying is that projects who are towards their end, of course, they're going to continue. But projects are in the early stage, they may get canceled or they may get chopped because of this. Okay. So it says that real estate industry professionals say they have heard of acquisitions being canceled due to interest rate increases and a more unfavorable financial environment. Neighborhoods with a lot of new units opening may see a pause in new proposals as lenders wait to see how newly built or soon to open projects perform. Meanwhile, some financiers are becoming more conservative. So you have these builders, and these builders they have sponsors or lenders. So what's happening is these lenders who are really the pocket of these projects, they're kind of taking a wait to see approach is what this article is saying. So again, if the project is close to being done, they're letting it run. But new projects, they're trying to wait to see, okay, how it's going to play out. Is the Fed going to keep on raising interest rates? Because if they are, a lot of them probably won't do this, but they're becoming more conservative, just as a whole. Okay. So it says that president of Liberty Properties, he actually said, I've heard that a number of lenders have pulled back and are on the sidelines until they know where interest rates are going to settle out. Because uncertainty, when things are uncertain, people pause. And that happens in real estate and it happens a lot of times in life. When people want to kind of know what's going to happen so they can plan. So they can plan, okay? So the article continues to say, but developers say that they feel confident that construction in the Philadelphia area will not grind to a halt, even as rates continue to rise. So there's some the developers in the Philadelphia area don't think things are just going to stop. Okay, he says they'll continue to go on even as these rates rise. And Philly is one of the poorest areas. Is the poorest big city. Okay, it's the poorest big city behind Detroit. All right, so things are still relatively cheap here. So this managing director of Dallas-based developer, he actually said that the froth has come out of the market, but it still feels pretty healthy. Okay. He also added that people won't be able to pay whatever they want for land now because it's becoming harder to make super aggressive assumptions. You have to be more, you got to be more steady and more in touch with reality. Because at one point in time, even with the housing market, people were just going crazy. People were jumping out the window because there was a dearth of opportunities. Meaning what? There was a dearth or there was a limited number of properties out there. So what he's saying is people just can't go crazy with buying land. People just, hey, I'll pay you whatever for that land. Okay. Well, he's saying that people got to be more in touch with reality, meaning what? That things are tightening up. All right. All right. So the guy says notes. Okay. So expected delays. So, but on the lending side, development industry players say that bigger banks are already getting more conservative. All right. One source at a prominent national lender who spoke on the condition of autonomy said that large banks have begun sitting on the sidelines, even when they are already involved in a deal. If it comes up for renewal or modification, many large actors have been pulling back. There's less construction loan capital available as a result. So all of these construction properties that you see going on, they have a lender behind them. They usually have a big bank behind them, giving them the money to do this construction. So what this is saying is that there's a guy who's a big industry insider. He's saying that these banks, they're kind of pulling back, meaning what? They're becoming more conservative. Okay. But the article also says that smaller regional and community banks and non-bank actors have remained more liberal in their lending. What does that mean? For us, mom and pop, for people who are on a smaller scale, we really should be looking at these smaller regional and community banks and these credit unions. We should be looking at these credit unions because they're still giving the bag. Okay. That's why. Because they're in business to make money. Okay. They're in business to make money. All right. So it says there will be some there will be some slowdown. Okay. Deal by deal. And this was said by Bernie Shields. Bernie Shields is actually the regional president for Philadelphia and South Jersey with M&T Bank, which is a big player. Okay. So this guy said that things are going to slow down. And I think that's something that we already know. He also said we haven't had somebody say they are putting a project on the shelf at this moment because of uncertainty around rates or costs. But we all should expect to see some projects that are proposed being delayed. All right. So he's somebody, he's the president of the M&T Bank in Philadelphia and Jersey. So what he's saying, he said, okay, I haven't seen any projects stop, but what you may see is projects that are proposed, they may get pushed back. Okay. So next it says home run projects continue. So the article continues to say that interest rates have been very low for very long, and they are still modest by historical standards. No one interviewed for this article expected that the interest rates would be hiked to anything like the 1980s level, when they soared to double figures under the Federal Reserve Chair, Paul, I think his name is Volcker, okay, Paul Volcker. There have been signs that inflation is cooling. Despite the July jobs report, if that trend solidifies, it could uncut the aggressive tightening. Okay. All right. The article also says, for now, though, the changing lending environment is likely to manifest into projects that aren't proposed or permits not pulled. There will be rural areas where a new Amazon warehouse doesn't sprout up, and outlying Philadelphia neighborhoods seeing a break from the construction blitz. All right. It feels to me like the sands are shifting through the strainer, and some things are definitely falling out. Now, this was said by the managing director of Longfellow Real Estate Partners. All right. They said, but projects that were home runs, although they might wind up taking a bit of a haircut on the returns, but home run projects will continue. All right, so that's the whole article. All right. So what do I get from that article? Or what does that mean? Okay, what does that mean for buyers and sellers, this whole article? What this means for sellers, if you're looking to sell a project, then what that means is that things are slowing down. Okay, things are, and I probably shouldn't say sellers. What I should say is developers. Okay, what is because this article is really talking to commercial developers. What that means is that you really have to be clear on your numbers, and you have to leave some room. You have to leave some room for that money getting more expensive. So it almost has to be a home run because yes, we don't know the future. If we knew what was going to happen in the real estate market, we would put all our chips on black and we will let it run, right? But we don't know. So we can only make a decision, the best decision from the numbers that we have right now. So what you should do is if you're looking to do some type of project, some type of development project out there, is number one, you should be going to these small regional banks or these credit unions. This is who you should be targeting in order to get your funding. Now, with them, most of them are relationship banks. So since they're relationships banks, then you just don't want to go to them and be like, "Hey, I want all of this money." No, you want to open up a checking account and a savings account, and you want to do transactions with them because they're going to look at the relationship when you go to ask them for the loan. Now, when you go to do these development projects, you're going to need some room. You can't be super aggressive. You're going to need some room for the interest rates going up. All right. And for the community, as far as the Philadelphia community, I don't think these projects are going to stop. I think people will continue to come in and build in Philadelphia because Philadelphia is super undervalued, in my opinion, and it will continue to be undervalued until we bring more businesses in, until we get a better way of running City Hall, until there's more transparency in where the money's being spent at, and also until we because there's a lot of underutilized properties in Philadelphia. There's a lot of unutilized land in Philadelphia. So when we start unlocking those and start building those up and start getting them to their full potential, then Philadelphia will be on the map. All right, y'all. This is Colin Nathan Lim, the real estate boy. If you're going to buy a home, sell a home, or invest in real estate, I got you. Take care.